Glyn, thanks for joining me, reflecting on the month of July. A month where it's fair to say we've had our fair share of exogenous shocks.
We have, and for most of this year we've been saying that central banks have been the driving force behind markets. It's difficult to say what was the driving force this month, but it was not central banks. And arguably it was the downing of MH17, which when we look back on this month might be a bit of a defining factor, because of course that has now led on to much more serious sanctions against Russia. But there were a series of events which have caused quite a wobble in markets as we got towards the end of the month, and the setback in markets that we have been looking for is certainly underway as we speak.
Let's stick with Russia for now. Obviously there's a lot going on there presently,
yes.
And the situation is quite fluid, but how does it look as you sit today?
Well, it is fair to say that prior to MH17, most European countries were reluctant to engage in very serious sanctions against Russia, because, as we've said before, Europe depends for about 30% of its energy supplies on Russia. The situation changed overnight, and there is now very little resistance in Europe, with so many Europeans, Dutch people in particular, having been killed in that disaster. There's now very little resistance in Europe to a tightening of sanctions, and indeed that's exactly what we saw towards the end of the month. The blame is being laid fairly and squarely on Russia, which has been supplying arms and probably people to the rebels in Ukraine. Putin is not backing down on that for the moment, and there's been I would say a serious ratcheting up of sanctions both by the US and by Europe, to the extent now that quite a lot of Russian banks no longer have access to equity and debt markets in the US and Europe, very significant. Certain supplies of oil equipment have been banned into Russia. That's going to have an impact on oil production longer term. And there have been a range of other sanctions introduced. Arms have been banned, new arms sales have been banned into Russia. Importantly, that's now beginning to have an impact on certain Western companies. Companies like BP, for instance, that have got a big oil interest in Russia have been hit by this. Quite a number of banks have been hit by this. So this is now beginning to bite, and there's no question that it's beginning to bite in Russia. The economy is slowing right down. We've seen a number of European companies that sell into Russia, such as Volkswagen, warning on profits because of a big slowdown there. The Russian market was down nearly 10% in the month. The ruble was down. So this is now beginning to bite, and it leaves open the possibility, a much more real possibility, of a further tightening of those sanctions unless Putin starts to back down a bit. So I think this is now becoming much more serious, and is beginning to have, at the margin, some impact on companies in the West, on markets in the West. In the past month, emerging European markets, which are nearly all on the eastern side of Europe, have been amongst the very weakest performers globally.
Let's move then to the Middle East. Last month we'd have been talking about ISIS. That's fallen firmly from the headlines now.
Yes, it has. The headlines this month have been focused on Israel and Gaza. Although that's obviously a catastrophe, it's not really impacting on markets because neither economy is significant in a global scale. Neither country produces any oil for export. So, and it's a continuation of course, of a long history of conflict between those two countries. The ISIS movement, as you say, has stalled as they moved in towards the southern Iraq. So there's been no impact on oil exports out of Iraq. It's still an ongoing problem. We shouldn't ignore it. But intriguingly, the oil price, which, if you remember, spiked up to about $115 a barrel at the time of the first ISIS surge into Iraq, has dropped down to about $105 a barrel, down 5 or 6% this month. So there is clearly ample supply at the moment. Markets are not worried about it, but there is this simmering problem. And of course, we've now got effectively a civil war in Libya, which produces about 1.5 million barrels of oil a day. There's some threats to that. So this is something we're keeping an eye on, but we don't see it as an immediate or short-term threat to markets.
Returning to Europe then, Portugal, BES gave us another cause for concern?
Yes. What has happened in the course of the past few weeks, I suppose, is a reminder of the fact that there's still a lot of fragility across Europe. The actions of the ECB have helped to bail out Europe, but there's still too much debt. The banks are still relatively weak. Banco Espírito Santo, which is Portugal's largest bank, not big on a global scale, but Portugal's largest bank, basically hit the buffers. They had some big write-offs. About half their capital has been wiped out. Share price down 85%. Portuguese market down 10%. There's only about a €5 billion shortfall, something like that. It's not big in the overall scheme of things, but it's a timely reminder that this is going to be a long haul before Europe is back to full health. And indeed, I thought it was intriguing this month that bond yields, government bond yields in Europe, fell to all-time lows, not just the last few months. And I think perhaps the most significant bond market, the German government bond market, the yields went down to 1.1% on the 10-year, slightly lower than where they were in July 2012, at the height of the Eurozone crisis before Draghi's famous speech. I think that's a very timely reminder that all is not well. It's going to be a long haul. And in fact, European equity markets were down about 5% in dollar terms, with the euro down a bit. So there's a little bit of a wake-up call there, a little bit of a reminder that it's going to be a long haul.
Let's move then from the big headlines to what's going on behind the scenes. From an economics perspective, maybe a slightly more positive tone?
I think so. A little bit more weakness in terms of leading indicators in Europe, in particular in Germany, which is the powerhouse, of course, and I think that is almost entirely related to what's going on in Ukraine and Russia. So that's why I said earlier, I think MH17 will become a very defining event for this month. But Europe, I think, will tick a little bit higher in terms of economic growth this year. Importantly, the US, which had that very weak Q1, which we always said was a short-term temporary aberration because of weather, bounced back with 4% growth in Q2, much stronger than most people anticipated. The payrolls, job creation remains very good in the US. Consumer confidence indicators remain good. So it's well on track for that 2.5% growth. And we're pretty confident about that. The 4% growth actually hit markets quite hard, funnily enough, because it made people think, goodness, the Fed's going to bring forward the timing of its first interest rate rise. We're less concerned about that because looking behind that 4% number, nearly half the growth came from inventory accumulation. Now, that's not sustainable. And I think what is happening in the US is the economy is probably growing at around 2.5%, something like that, on a fairly sustainable basis, and that still leads us to feel that interest rates are going to stay lower for longer. We're looking well into next year before rates move up. The Fed continued its tapering this month, of course, and there's no question they will complete the tapering program. It'll go to zero in October. That's very well flagged and is no longer an impact on markets. But overall, I'd say that the developed world is ticking a little better. By no means excessive growth, so nothing to worry about in terms of inflation. And importantly, we've seen a little bit of stabilization, better leading indicators from China. Q2 growth came in at 7.5%, in line with their projections for this year. So that was certainly seen as a positive by markets and helped the Chinese market recover by 8 or 9% this month after a pretty weak earlier period.
You mentioned German government bond yields at all-time lows, US interest rates staying lower for longer. But it's not all the same direction in the bond market at the moment, is it?
No, it's not. And I think one of the most significant market moves in July has been what's happened to high-yield bonds. We have said for a few months now that high-yield bonds are at excessive valuations, both in absolute terms and relative to government bond yields. Finally, the high-yield market came under quite some pressure. In the US, there was a negative return of about 1.5%. In Europe, a negative return of about 2.5%. Big outflows, about a $10 billion outflow out of US high-yield ETFs, the biggest outflows we've seen for a very long period of time. This is something of a wake-up call. It's an asset class which has got excessively valued. We pulled our positions a few months ago, as you well know. And I think it's actually a healthy correction, and indeed the sort of thing that I think will make this long bull market that we're seeing in most assets more sustainable. But we're watching out for that market because it's not the most liquid of markets by any means, and if that that big sell-off of high yield bonds continues, that could become more damaging. So it's one market that is still very highly valued and requires careful watching.
Finally then, we've talked about the ultimate safe haven, government debt. We've talked about a lot of geopolitical risk. Alighting on the gold price, it's not as exciting as you might expect.
Well, it's surprising, isn't it? Because on the day of MH17, the gold price went up a fair bit. It didn't stay there for very long, and in fact, it's sold off 3 or 4% this month. And I think most people would probably be surprised about that, given the background, because we've had a sort of mini Argentinian default in the month as well, although that was pretty well flagged. The geopolitics remains very unsettling, but commodity prices generally were weak in the month. The oil price was down by 5% or so, as I mentioned. Soft commodity prices very weak, down about 7.5%. Nobody out there is worrying about inflation today. It's just not on people's minds, and maybe gold is reflecting that to a degree. I suspect, though, that there's enough sort of concerns about the geopolitics and the longer-term issues of this whole sort of monetary process of normalisation to support the gold price, but commodities generally under some pressure at the moment.
Finally then, let's look forward. How is your outlook looking? Has it changed much over the last month?
No, I think we are in the midst of a correction. We saw on the final day of the month, just yesterday, Wall Street off 2%, the biggest single day fall for 3 or 4 months. Markets generally are down, equity markets down across the board, other than Japan and 1 or 2 other markets. But generally speaking, we need a correction. You know, markets have had a long rise, 18 months or so. As we've said repeatedly, valuations have moved up quite a long way. Share prices have gone up quite a lot more than corporate earnings over that period. So I think a short-term setback, and we're in the midst of that, is healthy. And we've seen that a little bit in some sectors earlier this year, like tech and biotech. So I think this period of sort of short-term setback, consolidation, call it what you will, is going to continue for a while, and there is quite a lot of uncertainty out there. But underlying all of this, economies remain reasonably good. Growth is good enough without being too high to cause inflationary concerns. Interest rates are going to remain very low for a long time yet. Monetary policy pretty easy for a long time yet. So I think the underlying environment remains good, and if we get this setback continuing a little bit, I think that will become quite a nice opportunity to add to risk positions in portfolios.
Great, thanks Glenn.